Thanks to learning of the week. So this week we were talking about financial literacy, really good workshops. They've all been different. So welcome to this afternoon's Link to Learning. This is Saskatchewan's webinar, but we welcome everybody across the country to join. So today's conversation is, where did I put it? Getting money. So what do investors and what are lenders looking for? It's a really good topic. So my name is Michelle. I am co-emceeing with Aubrey, and she's going to talk in a couple of moments. So welcome. We are honored that you have joined us this afternoon, that you chose us. I'm sure there was a lot of options you had out there and you chose us. So we feel really honored that you are here. And our guest speaker is Zachary, who's joining us from Regina, Saskatchewan, and Monica with Business Development Canada. She's going to share a couple words at the beginning. So welcome to our guests. We are happy that you are here. There's going to be an opportunity after the presentation for any questions or any comments or any dialogue. So feel free to lend your voice to this conversation and feel free to ask the questions. There also will be, after this, there will be an evaluation link sent to you, and we would love to hear your feedback. And when you fill out that evaluation link, your name will be entered into win one of two $400 Visa gift cards. Like, what? Think of all we were just talking about online shopping. Think about all the online shopping that you could do with that $400. Or maybe, since we're here talking about financial literacy, maybe you invest that money. Who knows? So welcome. We're glad you're here. So on Tuesday, the presentations were, so you can go back. So Cando records all of the presentations, all the workshops, and we post them on the website. So Tuesday morning, we had one of our speakers talk about the top 5 common mistakes startups make. It was really informative, really going back to the basics and talking about starting, business plan and all of that information. It was really, really good. On Tuesday afternoon, it was understanding financial statements, and that guest speaker covered a lot of ground, and there was some good discussion that had happened afterwards. This morning, we talked about why healthy balance sheets matter. So if any of those are of interest to you, feel free to go to our website and check out the videos that are posted. So Aubrey, I'm going to pass it off to you.
Hello, welcome everyone. I'm seeing some familiar names in this group, so I'm definitely happy to see that. And to everyone else, very nice to meet you. As Michelle said, my name is Aubrey Ann Liberty Popisconius, which is a huge mouthful. So if you ever need to get in contact with me, just call me Aubrey. But I'm so excited to have here today both Monica and Zachary. I've heard great things about both. Zachary and I were just talking right before this about how we both have been in northern Saskatchewan and enjoyed the beauty and the bugs that come with that area of the land. But I'm so excited to welcome them to the stage, especially this workshop. This Links to Learning, it's going to be so interesting with how much you're going to learn about just financial literacy in general and advantages and disadvantages, and hearing from some really knowledgeable people. And so feel free to get your questions ready throughout this. They're here so that you can learn from them a bit more. And I know you're going to have questions after that, and never be scared to ask questions, because I feel like if you're thinking it, other people are probably thinking it. So you're not only helping yourself out, but you're helping out others. So definitely welcome everyone. So nice to meet you. But I know you didn't come to hear me speak. And so without further ado, I will hand it over to Monica first from Business Development Canada. So welcome, Monica.
Thank you very much, Aubrey. Tansei, I'm joining you from the Treaty 1 territory and the homeland of the Métis Nation in Winnipeg. I am actually, my ancestors, I'm a member of the Peter Ballantyne Cree Nation, so that's in northern Saskatchewan, some of you may know. I see a Morin on there. I have relations, Morin, the relations were probably related some way. So I was actually born and raised in northern Manitoba in a small town called Flin Flon. So it's very small, 5,000 people, very nice, tight-knit community. But you know, being Indigenous and living in a small town, let me tell you, I understand both sides when it comes to looking for help as being an Indigenous person and also being in a remote location, not having access to some of the other resources that, you know, some of our people that in urban centers have. I've been with the Business Development Bank of Canada for 18 years, and it's been my mission here for 18 years to make sure that the voice of my people is heard and that BDC is moving that needle in terms of our support. I'm so grateful that we partnered with Cando and CPA Canada to deliver these financial literacy training sessions. This is the fifth and final session, but there's always more if there's a need. We ended up doing a joint study with NACA back in 2017 on what our people need for our Indigenous entrepreneurs. And one of the big things that came out is financial literacy training. So we're grateful that we've all partnered together because we see this as knowledge that we're able to pass on to our people and create that own prosperity for our people. So I'm going to hand it over to Zachary, and I'm really looking forward to this presentation because this is my cup of tea here, and I'd be happy to provide some insight. And at the end of our last presentation, there were some really good questions which we could potentially continue on when we're done. Zachary?
Good afternoon, folks. My name is Zach Solomon. I live here in Regina, Saskatchewan. As Aubrey had said before, I did live in North Saskatchewan. I lived in the community of Buffalo Narrows for about 8 years. Worked for the Health Authority, Q8 Niate Regional Health Authority. I love the North, and I go up there every summer. My family and I, we have a spot up there, and so we're connected to it. I really appreciate the opportunity to be able to deliver this presentation to you folks, and in collaboration with Cando and Business Development Bank of Canada and CPA Canada. I am a CPA, CPA CMA, and I also have my risk management designation. I work for the Ministry of Government Relations. I'm the Director of Grants Administration. This presentation is designed to be interactive. So there is a Q&A session at the end of the presentation where people can ask questions, and you can ask questions throughout the presentation through the chat. It's a little bit different with Zoom, but if anybody wants to, you know, or can unmute their mic and ask a question during the presentation on any subject that I've touched upon, feel free to do so, because it's meant to be interactive, and so you don't have to save all of your questions till the end of the presentation. We have about an hour together today, and so if everybody's ready, we can get started. Okay. So today's presentation is on getting money, what lenders and investors want, and so what they need to know from you. So some common questions that business owners need to ask. So why will I need additional financial capital? What are the typical sources of financing? What are the advantages and disadvantages of using them? And we're going to touch on these throughout the presentation. Knowing what's the difference between a lender and an investor. Yeah, why do I need a business plan and how do I create one? What are leverage ratios? And how do leverage ratios vary between different business types? And how do lenders look at my business? So there's the 5 C's of credit that we need to take under consideration. And I'm going to go back to something that both Monica and Michelle had and Aubrey had said at the beginning of the presentation. So what you're going to see during this presentation will touch on some of the other financial literacy presentations that have been offered in the past. And so if anybody's an aspiring entrepreneur out there, I would encourage you, if you haven't attended any of those previous ones in regards to balance sheets and understanding financial statements, to review those financial literacy sessions, because it will touch upon those things. So in regards to character, it's your reputation as a borrower, and it's your reputation as an individual within your community, within the business world, et cetera, may have an impact on your ability to get credit. When it comes to capacity, that is your ability to repay your loan. And so as we go through this presentation, we will touch a little more deeply on these 5 C's and the different pieces, including capital, collateral, and conditions. Lenders and investors will be looking at capital, your commitment to the business. How much have you personally invested, or even got family and friends to invest into this company to show that you have stake in the game, is really key to what lenders and investors look at. Collateral, if you have something of value that a lender can secure their loan against, and the terms and the conditions of the loan, so length, etc. So why would you need additional financing and capital? So here's a few examples. So sales growth, something to consider. If you're a small business owner and you're selling a piece of merchandise, and you find that you are running out of your inventory on a regular basis, you may need to purchase additional equipment so that you can keep up with the demand for the products. You may need to add on to or acquire a warehouse so that you can store more things. So sales growth and demand for your products can really drive the need for additional capital. As I said, a warehouse for storing inventory also connected to sales growth. Facilities and staff expansion. And a lot of this is driven by the first thing. Sales, you go into business to make money, and one of the biggest drivers of making money in your business is your ability to increase your sales, which increases your year-over-year revenues and your quarter-over-quarter revenues. And so that will drive the need to have either a larger facility or the ability to hire more staff. And in this day and age of COVID-19, we have proven to ourselves that you don't actually have to have all your staff located in a physical location, but you will still have to pay them. And another reason why you may need to have some capital available to you is if there's a mismatch in revenues and expenses. So you may be able to drive some revenues from some of your sales activities, but there may be a lag in the time that it takes you to collect the dollars associated with the revenues that you've generated. And so as your expenses come due, you may have generated the revenues, but you haven't collected the cash associated with those revenues because you've sold things on credit, and you may have given some of your customers 30 or 60 days to pay. And so you need to have some money available to you to be able to float between that time frame of when you're making your payments and when you're collecting your money. So typical sources of financing and capital. They basically boil down to these two. It's either a lender or it's an investor. And so we're going to go through the difference between the two. So lenders, they can be banks, it can be individuals. You'll have agreements in place. and they'll lend you money at certain times, and there will be conditions associated with it. A lender does not own part of your business. They tend to be relatively hands-off. Their main goal is to make some revenue off of the interest for the dollars that they lend to you. And there'll be specific reporting and periodic terms to the lending of the institution. Typically, most of your lenders are banks, but there are different other lending solutions out there other than banks. But most times, most of the lenders are banks. When it comes to investors, an investor is actually buying a portion of your company. And so they assume the risk of their investment and they expect to receive a reward. And so their reward is a sharing in the profits. It will either come to them in the form of a dividend or from the increase of the share value, which they could sell and make a profit. Depending on the arrangement that you have, your investors could become more intrusive. So in the situation of a company that is privately owned, is a partnership per se, or a sole proprietor where you have people buying in, those investors may want to have more control of your business on certain aspects. They may require that a board is appointed and have more oversight in certain areas and place some covenants in place, and which can also trigger some painful provisions if targets are not hit. And so depending on the type of arrangement, there could be a situation where control of your company is relinquished to the investor, to make sure that their interests are also protected. From other perspectives, if you get to a point where you've been able to grow your business to a point where you're going to a stock exchange, those type of investors are much far more removed, and you can go into those markets such as the venture market to raise capital, venture capital to get a project or a business off the ground, before you go into your regular markets like the TSX, where you're an active business and you're constantly trading your shares are constantly being traded on the TSX or the New York Stock Exchange or any of the other stock exchanges that are available around the world. So, character of the borrower. When it comes to evaluating your character from a lender's perspective, they will look at your credit scores, both business and personal. And the reason why they'll also look at your personal credit score, in addition to your business personal score, your business credit score, is to determine if you are at risk. So if you've had a situation where you've declared bankruptcy, lenders are less likely to lend you money, because there's a risk that you may have poor money management skills. Even when it comes to the workplace, if you can't be bonded, you may not be able to go into positions where you're responsible for money management. And so beyond the creditor side of things, when you're hiring your employees, et cetera, there might be certain background checks that you want to do with officers of your business that may impact the overall reputation of your company. Experience in the business is a key thing that both lenders and investors will look at. And so when it comes to your experience in the business, it will give a picture of your ability to deliver on your goods and services. So if you're relatively new to an industry or an area, it presents some risks to conventional lenders and investors, especially if it's an area that has a lot of competition. And so in going into that, and this is not to discourage anybody who doesn't have a lot of experience in a certain area, because you could come at it as a disruptor and you might have something new that the market has never seen before. And being able to sell that story and pitch that story and get lenders and investors to invest in you. However, if you're going into a fairly mature industry or business sector, this is one of the key things that they'll look at to see if you're able to survive and if you've made those attempts to understand that business before you enter the arena. Your experience with lending institutions. So if you have a long track record with a positive track record with lending institutions will tend to borrow money to you more readily and at a lower interest rate because they have a good experience with you and know that you have the ability to meet your obligations with them. Your reputation within the community. So reputational risk is a key risk for lenders and investors, and no lender or an investor wants to be associated with a business or a business owner that may have a disparaging reputation. And so whether it be criminal activity, risk of fraud, inappropriate social activities in this day and age of social media, things that you say online, all of those things that could potentially hurt your business will also hurt your ability to borrow money. And also your relationship with the lending officer. So if you have a long-term relationship with a lending officer, it's about relationship building, and you're able to build that trust. And trust is key in all aspects of life, but in particular in business, as people are able to trust each other and they have a track record and can prove that they can meet their obligations, and not just meet their obligations, but they can build their company and build it beyond what people's expectations are. It builds that comfort level between you and your lender, and it's an important relationship to build over time. So measuring capacity. And so we're going to go through these different ratios that are on the screen here. Just to give a quick explanation of the ratio analysis, liquidity ratios are ratios that determine how solvent your business is. And what is meant by solvency is how quickly can you convert your assets of your business into cash. And your leverage ratios focus more on the debt and equity side of your business. And so when it comes to debt refers to loans, mortgages, etc., instruments that you've received from the lender. And equity refers to all investments that are made within your company. So whether your own personal capital or any shareholders or investors that have invested into your company. So up on the screen, I have the calculation for the current ratio. And as I said at the beginning of the presentation, this will build on previous presentations. And so when you look at current assets and current liabilities, you will find this information on a balance sheet. And so if you're unfamiliar with the balance sheet, I would encourage you to go back to that financial presentation of why a balance sheet matters. And this is not part of the presentation, but to give folks an overview, there are three key financial statements that lenders and investors look at, and when you have to build what is called a pro forma financial statement, which is part of your business plan, and it shows how you predict and anticipate your business is going to move going forward. And so the three financial statements that are key are your income statement, also known as your profit and loss statement, which shows your revenues and your expenses. Your balance sheet, also known as your statement of financial position. And on your balance sheet, it will include assets in their different classes, liabilities in their different classes, and equity in its different classes. So to get your current ratio, you take your current assets and you divide them by your current liabilities. And a current asset is an asset that is can be easily converted into cash. And so it would include such things as accounts receivable, cash, securities, which would be certain investments that you could easily turn into cash, inventory. And that's mostly that. And then for current liabilities are any of those liabilities that you expect to meet your obligations within a year or less. And typically, current liabilities include your payroll, so your salaries payable. It could be the current portion of your mortgage, the current portion of your insurance, and any trades payable, so anything that you have to pay to suppliers. If you have a current ratio that is less than 1, you have a problem. And what that means is that you're technically insolvent, which means if your creditors, your current creditors, were to come and ask for their money today, you wouldn't have the ability to pay them. And so in this example, it shows that this particular company has a current ratio of 1.5. And this is important to lenders because lenders may put some covenants on where, depending on the amount of money that you're borrowing, depending on the maturity of your business and the size and nature of your business, a lender may say to you that you need to maintain a specific current ratio. And they might say you need to maintain a current ratio of 2. Otherwise, your loan could be in default. So another variation of a liquidity ratio is the quick ratio. And so with the quick ratio, it's essentially the same as the current ratio, with the exception that it minuses out inventory from that calculation. The reason why it minuses out inventory from that calculation is because inventory may not move. So sometimes inventory is liquid and it can move off the shelves. But if you have a company that's falling into trouble, it's usually because they're unable to sell their inventory. So for you as a potential entrepreneur or business owner, or as a current business owner, these are things that you want to look at for yourself. The lender will also look at them, and an investor will also look at them. And so in this presentation, you can look at yourself from all of those perspectives. You may be a potential lender, you may be a potential business owner, or you are a business owner, or you're an investor or a potential investor. And this applies to any size of business. So leverage ratios. So the ratio that we have up here is the debt to equity ratio. And what it does, and your liability is also equity, and liabilities is also found on the balance sheet. And so what it does, it takes the total liabilities, not just your current liabilities, but your total liabilities, which will include your total liabilities and long-term debt. And so long-term debt can include, such things as lease obligations or mortgages. If there's a loan on a company vehicle, for example, that's also included in there. With respects to owner's equity, it is the residual of what is left in the business. And from a balance sheet perspective, to get to owner's equity, it is equal to your total assets minus your total liabilities. It's also known as retained earnings. It's also known as net worth. And so when calculating this leverage ratio, it essentially shows how much of equity is covered by liabilities. And so it is preferred to have a lower debt to equity ratio. However, certain businesses will have higher debt to equity ratios because they're capitally intensive. So some examples of businesses that tend to have a higher debt to equity ratio is real estate, for example. Companies with a lot of infrastructure, pipelines, and other type of infrastructure type buildings or businesses, because they have so much capital that's required and it's a fixed cost that is needed to run their operations, that the debt to equity ratio can be a bit higher. If you are as a small business owner, you want to kind of keep your debt to equity ratio on the lower end. Now, that's not to say that you shouldn't have debt. As we identified in the earlier slides, you may want to take on debt to increase your revenues or to increase your capacity, add more staff, which essentially will increase your revenues and increase the bottom line. So the interest coverage is another ratio that indicates whether a business is earning enough profit to pay its interest. And so the operating profit comes from your profit and loss statement or your income statement. So your operating profit is your total revenues from all revenue sources minus your cost of goods sold minus all of your operating costs. And that will give you your operating profit. And so, again, lenders and investors want to see a higher interest coverage ratio. So 2 or higher is preferred. And so it essentially says that you're earning twice, at least you're generating a profit of at least twice your interest payments. And it shows that you're able to meet your obligations and pay the interest down on your debts over time. So there's an example at the bottom here that shows a fairly healthy interest coverage ratio of 12.2. And so look at it from these varying perspectives, as either a potential business owner, as a business owner, as a lender, or an investor. Similar is another fixed payment coverage. And so this takes into consideration your operating profits and your asset lease payments. And so that will include the lease of buildings, include the lease of vehicles, et cetera, any type of asset that you're leasing. And then that is then divided by the interest and the principal. The asset lease payments eventually end up canceling each other out because they're both on the numerator and the denominator, but it includes the interest and the principal side. And it shows the ability to meet not just your interest payments, but also the principal portion of your loan. And so you can see at the bottom from this example, there's a coverage ratio of 2.6. And most lenders prefer at least 2 or better. The higher you can have this number is always better from the business perspective, and also reduces the risk that the lender or the investor is looking at. So the more leveraged a business is, the more risk it takes on. And so for some companies, the maximum acceptable debt to equity ratio is 2. But like I said earlier, some of them will have a higher debt to equity ratio, and it's just because you're in a more capital intensive type of business where you have to take on additional debt to run your business, and it's just the nature of the operations that you're getting into. So I'll move on from this on. In regards to capital, your lender or your investor wants to know how much of your own money is invested in your business. So how well capitalized is your company? And do you have enough capital to withstand losses? And so when you're looking at your equity ratio, you take your capital stock plus your retained earnings. Usually in a sole proprietorship, which means it's owned by one person or it's a partnership, you're usually just dealing with retained earnings and not capital stock. And your retained earnings also can be considered your net worth. And so think of it from the perspective of a savings account. And do you have enough money in your savings account? If you were to lose your job, are you able to continue to pay your rent and buy your groceries for the next 3 months if it takes you 3 months to find a new job? So it's a similar type of concept that lenders are looking at from the capitalization perspective to say, okay, if there's a downturn in the economy, and 2020 and 21 is a prime example. Nobody anticipated to be hit so hard by COVID-19, to have a pandemic flowing through, and number of stressed businesses out there being in a situation where the economy is locked down, you have a reduced number of customers. How are you going to actually be able to make your payments? And so they will look at how much capital do you actually have. And as I said, your retained earnings is your total assets minus your total liabilities. So essentially, how much cash do you have? How much liquidity do you have to be able to meet your obligations? And with that, in extraordinary circumstances, will determine how much leeway a lending institution will give you, where they may give you a grace period because they see that you're well capitalized, you have a good reputation, you're scoring well on the 5 C's, so they can extend, the risk to you for a longer period of time because they feel confident that you will be able to get yourself back on your feet once a recession or a pandemic or any type of downturn situation is over. Collateral. So as the slide says, collateral is a property that will be seized if loan payments are not made as agreed to. And so when you put up collateral on a loan, it's considered a secured loan. And essentially a lien is placed on that collateral. So a very common type of loan transaction that you don't have to be in a business for, that includes collateral, is a mortgage. And so I don't know if there's any homeowners in the audience, but when you get a mortgage, part of the mortgage agreement is that you technically do not own your home. It is owned by the lending institution until your mortgage is completely free and clear. And so similarly, when it comes to getting a secured loan, you will put up a piece of property that has some value that the lender could seize in the event of a forfeit. Usually collateral is an incentive for the borrower to make payments, and that's also an incentive to the lender to loan, and understanding that their risk may be covered. There are risks still associated to the lender by taking collateral, and so the loan to value ratio typically varies at less than 65%, which means that the asset that is put up as collateral typically doesn't cover more than 65% of the value of the loan that's outstanding. And so from the lender's perspective, they are taking on some risks if things have to be secured by collateral, because that asset could be impaired, the value of it could change, the value of it could appreciate as well. So the borrower themselves will take on that risk, but typically most things depreciate as opposed to appreciate, unless it's real assets such as buildings and land. Loan terms and conditions, and these will vary widely based on the perceived strengths and weaknesses of the borrower. Common features of a loan are your interest rate, fees that are associated with taking out a loan, the length of the loan, also known as the term, a fixed amount or line of credit, interest only periods, triggers to accelerate payments, and triggers to change rates of interest. So I'm going to go through each of these points a little bit here. So the interest rates are also driven by the 5 C's. And one of the biggest 5 C's is your capacity. And so if you are deemed to be risky or a riskier investment, the interest rates tend to be a bit higher. Or if you have a lack of credit, so you've never had a credit card, you've never had a loan, etc., it shows that there's you have a lack of credit experience. And so it's not necessarily means that you'll do poorly with handling your credit, but because you're an unknown, you're perceived as an increased risk to the lender, and so therefore you typically get charged a higher interest rate. Fees. So some financial institutions, such as credit unions, for example, and not all credit unions, so I won't lump them all together, typically charge fees to take out loans. Throughout the loan, depending on the structure of your loan, there may be fees that are associated with late payments, extensions, forgiveness, etc. The time and length of the loan is a key consideration. So the longer a loan is, the more interest that you're going to pay. And keep in mind that whether it's a lender or it's an investor, it's a business to them. And just as you are in business to make money, they're in business to make money. And so they have those considerations in place. If they feel that you are a higher risk borrower, they will want to shorten the length of the borrowing terms. You as a borrower also need to take into consideration your capacity to pay things over time, and if at all possible, to have a shorter time frame, because you expect to generate greater revenues. You may want to have a shorter term for your loan. Another way to look at it too is that if you also think that you're going to have a fairly good year and increase your quarter over quarter and year over year revenues and be able to meet your obligations sooner, you may still want to take a conservative approach and keep in mind that you can have a longer term loan and pay it off faster, but understand if there's any penalties to paying off your debt sooner than the obligated time. Fixed loans or variable interest rates. If you have a fixed amount, it's a set amount. So say it's $100,000 that you're borrowing at 5% annually. your payments and the amount that you owe will be set throughout the term of the loan. If you have a line of credit, you only pay interest on the amount of the line of credit that you draw down. It's considered a revolving loan. So say, for example, same example, you have $100,000 in line of credit, you borrow $30,000. The $70,000 just sits there as a line of credit, and the $30,000 that you've taken out will then start incurring interest charges and payment obligations against it. Some financial institutions and some loan agreements may have an interest-only period in it. The advantages of an interest-only period is that your payments, your initial payments will be lower than having to pay the principal. And so that interest portion for a business owner is tax deductible. So it's an eligible business expense that will reduce any taxes owing. But one of the drawbacks to an interest only is at the point in time when that grace period of interest only expires, the cost of your loan will increase significantly because now you will have to pay the interest plus the principal portion of the loan. Things that may trigger the acceleration of repayment. So as we had gone back on the previous slides and we looked at different ratios, if there's a covenant in place that says that your current ratio has to be at a certain level, and say it's 1.5 or it's 2, and throughout the loan period, say you have a 10-year loan, and in year 5, your current ratio drops below that 2 covenant, your lender may ask you to pay off the balance of your loan. And that will be, the covenants are not surprises. They are things that are built right into your loan agreement. And so if you enter into a loan, make sure you review it carefully. You may want to take someone with you or have a lawyer review it to make sure that you understand everything that you're entering into. Triggers that change interest rates. And so again, similarly, your ratios, changes in ratios, a drop in your earning potential, etc. Anything that makes your business seem more risky to the lender could trigger an increase in the interest rate. Typically, changes to interest rates are not instantaneous. They look at things over time. One of the biggest triggers to a rate increase is the failure to make your payments on time. So late payments or missed payments definitely put you under the microscope with a lender to say that you're riskier and they want to increase your interest rates. So from the investor perspective, investors have their own expectations as well. An investor expects to have an equity or stock in the position in the firm, which essentially means that they're going to be an owner. They're going to own a portion of whatever they buy into. So whether you're a sole proprietorship or you're a partnership or you're a corporation, an investor is going to have some ownership and is expecting to, see some benefit from that ownership in the terms of earnings. Investors tend to require more monitoring and want to be more involved in the firm. And so they want to ensure that their investment is protected. And so, they'll have expectations. They will want to see regular financial statements. They will definitely want to see your profit and loss statement to see if you're profitable. They will want to see, your statement of cash flows to see where money is being used and how money is being generated. and if there's a net increase or net decrease to the money that's being used within your organization. And they will want to see your balance sheet to see how the net worth, the value of the company is progressing over time. They may also want more protections, for example, life insurance. So life insurance is an interesting example. So for corporations that typically have boards, and if you have boards or you have senior officers within your business that have, specific knowledge or things of that sort, or there's expenses that need to be covered and it's part of the compensation package, insurance is something that may be associated with that. The ability to force payouts at special terms. And so an investor wants to protect their interests, and so there may be special covenants that are in place that will force payouts. So they may have some say as to when dividends are being dispersed, because they want to make sure that they're able to recover the value of their investment and reduce their risk to themselves. Business plan. A current business plan is key to obtaining credit. And so, as I said before, there are essentially three key financial statements that need to be part of your business plan. And that is your income statement, also known as your profit and loss statement, your balance sheet, and your statement of cash flows. Putting together a business plan is not just putting the numbers together. So when you put together your business plan, you need to be able to show and present to the investor or the lender that you have an understanding of your business and you know what it takes to make your business successful. So in addition to your pro forma financial statements, you're going to have notes and assumptions that accompany those statements. And you have to make sure that you make clear your critical consumption, your assumptions. So if you are projecting to have losses for the first 3 years of your business, and then in year 4, you expect to have a profit, both profits and losses need to appear to be realistic. One of the things that will set off a red flag is that at year 4, when you expect to be profitable, is if the lender or the investor automatically sees this huge surge in profitability that can't be explained by anything. So things that you need to take under consideration is over time, if you have a loan, such as a mortgage, etc., when is that debt going to be extinguished, and will that have an impact on your profitability? Your forecast should be anywhere from 2 to 5 years and should show if there's going to be new debt, and also if you expect to be raising other sources of capital, increased expenses, increased revenues, or reduced expenses, or potential reduced revenues. It's always best to be somewhat conservative on the revenue side of things and maybe a little less conservative on the expense side of things, but try to be as realistic and know your business as well as possible, not just for your lenders and your investors, but this is for you as a business owner more than anybody else. So bankers and investors, they see you as a potentially profitable customer or partner. And like I said, it's a business, and the key thing for anybody who goes into business is to make money. And so when you're dealing with a lender or an investor, keep that in mind. They want to work with you to make profit for themselves. And the way that they make profit for themselves is to see you be successful. They have a potential way to lose money. And so for a lender, the amount of money that they lend to you is at risk. So if you default on your loan, all or a portion of it, that lender is out that amount of money. And similarly to the investor, if you do not run a successful business, either no fault of your own or due to mismanagement, that investor's investment is at risk of being a potential loss. And again, from both perspectives, they also see you as a risk management problem to be researched. And so in doing their research, they're going to look at those key things, you know, your 5 C's, your capital, your character, your capacity, etc. Your presentation of a business plan, an understanding of your business, your flexibility to operate in a downturn. Do you have a proper understanding? How much skin do you have in a game? What are your projected year-over-year revenues? What are your projected year-over-year expenses? You know, are things progressing and increasing in the right direction? Are you in a highly competitive industry? Are you a disruptor that they know nothing about? Sometimes you have to find a different type of investor who's more willing to take on that type of risk and is not as risk averse. So for you yourself as well, you know, you want to do your research and understand what type of institutions or investors that you're willing to partner with. So we've come to the end of the presentation. I believe everybody has a copy of this presentation. And you know, on this last page here, it has some links to information here as resources, and it'll also have a glossary term. If there's any questions that can't be answered in the Q&A that anybody has, feel free to reach out to me through Monica or Michelle or Aubrey, and I will try my best to answer your questions. But I open the floor for any questions.
Maybe to get some dialogue started, we can continue on from the conversation we had at the end of the last presentation, Michelle. And one of the questions was, what do we think is happening with interest rates, and what should you look for? And the advice that I give is that interest rates are at an all-time low right now. But one thing that you have to remember is, if you know anybody that's got a residential mortgage rate, the rate is fairly low. A commercial mortgage is going to be higher than that. And if you're going to be buying equipment, it's going to be even higher than that. And if you need money for working capital where there's no collateral or no security or something the bank can take a charge on, it's going to be even higher than that. So that's like working capital. So if you need to buy more inventory to make your product, or you need help doing a marketing plan or doing your website, that's all working capital, is nothing tangible. So it's going to be a higher rate. And when you're looking for a loan, you want to be shopping around, but being cautious. So you want to know what banks you should be working with. But every time you go to a bank, they pull a personal credit on you. And so we've seen time and time again, people will come to us and in a 3-month period, they've gone to 5 banks, and it drops your personal credit substantially, sometimes to a point where we're not able to potentially support based on other things with the program. So just make sure that every time you go somewhere, or let's just say every time you end up going to Canadian Tire or the Bay and you get one of those a card for that company, that is a hit on your personal credit. And the only way to build your personal credit is to be making payments on, if you have your Canadian Tire card, that you're making your payments on time, making sure that you're not late on your payments, because that will detrimentally affect your personal credit.
Yeah, I'm really glad you brought that up, Monica, because I had no clue. I was under the impression, oh, if I just shop around to see what bank could give me the, best rate, and you saying that if you do that, that your credit would.
Yeah, credit score. Well, your personal credit, your Equifax or TransUnion. Yeah.
Would be affected. So that's really right there is really good knowledge that I actually had no idea. So thanks for bringing that up. I know we have a couple of moments. Does anyone, and also for those, we will be emailing you this PowerPoint presentation. So you don't have it right now, but you will get it. And so it's, good to have to look over, checking out also those glossary of terms. So that is coming your way. But does anyone have any questions or comments at this point?
There's one question there from Trevor, asking if your personal credit will boost if you end up paying your loan off early. No, it doesn't actually boost your credit. Just making sure that you're actually making those payments on time. I guess the way that it will boost your credit is another thing that so there's a number of things that they take a look at. And like, if you had a student loan back when you were 18, which was for me about 5 years ago, every credit that you've actually had is on your personal Equifax. And what I suggest everybody to do at least once a year is to go on to Equifax, TransUnion, and request your own personal credit report, and it'll show everything on there. And you want to make sure that no one's actually getting credit in your name. And so what it will do, a couple of things is that, if you have like a personal loan, you have a line of credit, and you have a vehicle, all of the money that you have outstanding is your credit utilization. So if you end up decreasing that a little bit by paying it off early, depending upon how much you have with everything else, then it will boost it that way, because you won't have used as much credit.
One of the things that I'll add to that, if you don't have a penalty period for paying off your loan faster, one of the things that you're going to look at, that you want to look at, is the debt servicing charge and how much interest you're paying, month over month for paying that. And so you have to look at the opportunity cost of, should I continue to manage paying that debt, or do I pay it off early and it gives me an opportunity to invest in something else? And so in addition to what Monica was saying about how you build up credit, there's another side to that of how you build up wealth as well. And so for everybody who's in the room who's over 18, you actually are entitled to invest into a tax-free savings account, which is also considered liquid. You're able to make earnings tax-free on that. And as you go forward, when you want to show how much wealth you have, that's another instrument to show that, hey, I have some savings and it has grown. So you're always making an opportunity cost of saying, okay, well, I'm making this little payment here over time and it's not breaking the bank, but make sure you look at the statements and see how much you're paying and that debt servicing, the interest rate, et cetera. And so if you didn't have to pay that, where else could you put it?
It's really good. Thank you. I also liked what you said. And I learned this many, many moons ago, but, having in your bank or in your savings account, having 3 months worth of the bills. So in case, right, like no one anticipated, last year and how that would affect our businesses and how we do things. So I think that, having that little nugget off to the side is really, really important. And I know some of us had to tap into it during COVID and during this pandemic where, hours were cut, people lost jobs, especially for entrepreneurs, so good advice, really good wisdom. When I think of those 7 sacred teachings, I really think wisdom is one we really need to tap into when it comes to financial wellness and financial literacy. And I think it's so important. So we really, really appreciate that you took the time just to offer some, a little bit of education around that. And so we really, really appreciate you, Zach. Thank you, Monica, for being here as well. It was really good to meet you this week. So thank you for being here as well. You have a really good, passion. You have a really good passion behind you. So thank you for sharing that. Aubrey, do you have any final thoughts here before we close up?
Yeah, I just guess, Michelle has said it so well. Thank you both so much. I think you had so much knowledge to offer. And as somebody who's currently a finance major in school, I still found myself learning from what you both had to say today. And so I'm very appreciative of that. And I do think financial literacy is so important. And I want to know how to teach people about it one day too. And so you were definitely great learning experiences for myself as well. But thank you so much for being here, and I hope that our paths cross again in the future.
Thank you.
And for those who got on a little bit later, this webinar, and then there's 3 more, and they're all different, and they're all really, really good. Check out the Cando website, and you could watch it on the replay. So thank you for being here. We just want to say thank you to Creator for the gift of another day, a gift of being able to learn from afar. Zachary's in Regina. I'm here in Edmonton, and I got the opportunity to learn from him this afternoon. We give thanks for all the gifts of lands, the water, the animals, the plants. And then we give thanks for all of, our relatives, our mothers, fathers, grandmothers, grandfathers, our children, aunties, uncles. So we just give thanks for the gift of relationship. So I hope as you go on for the rest of the day that you carry gratitude in your heart for all that you have. Peace, everyone.
Bye, everyone.